Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. Friday, February 28th, just after the close. What a week. What a week. Sometimes we need these type of weeks. It's almost like breaking open an ammonia pack and taking a sniff. Really waters your eyes, grounds you, gets you back to risk and reward. What did we see this week that was noticeable? I don't have to go over headlines. As I've said continuously for the last 6 weeks, we don't know anything about the virus that you don't know, that isn't covered in the media. What we have to do is try to react to what the market is telling us. A couple interesting facts this week. 30-year Treasury bond. 30-year Treasury bond cracks 170 and closes at 167. 167 on the 30-year, all-time low. What's important to us when we're trying to analyze asset classes and where we want to allocate capital is that 167 is below the dividend yield on the S&P 500. Let's call the S&P 500 176, 177 maybe at the close. So 8-9 basis points below. If you recall, last September, we were talking about the 10-year Treasury. The 10-year trading down through the S&P 500. And the fact that when that happens, we tend to look at that as a driver for equity capital. And indeed, when that happened, September got strong, October, not just because of that. It may be coincidental, but it's information that we need to process. 30-year through the S&P 500 dividend yield is something we've really got to put our minds around here. If you're a handicapper of equities and fixed income, and you say to me, personal information, everybody has their own objectives, their own goals. Do I want to invest my money in a 30-year Treasury at 167? Or invest my money in the S&P 500, pick up 175, 176 in dividend yield, and roll the dice that over the next 30 years, the companies, those 500 U.S. companies, can provide me with some capital appreciation? That's where I'm going to err on the side of. That doesn't mean that's right for you. Keep in mind, there still can be plenty of volatility to the downside. So you must be willing to accept that risk to also make that decision. But it is a piece of the puzzle that we need to really concentrate on here at Cumberland Advisors. Let's look at a couple other things. You've heard the bad news. You've heard about the virus. Let's go over some things we like to look at day by day. David Kotak took the S&P earnings number down to right in the 165 area for the year. But with rates where they are, feels that we may trade to a 20, 22, maybe higher PE that does provide an awful lot of support in this range in the S&P. We also look at things from a supply and demand standpoint, from a technical standpoint. And sometimes I need to play a game with myself to look at a security or look at an index and take an objective view of it, especially in light of the constant headline news that just keeps cranking out around the around the clock these days. So what I wanted to do is put a chart up for you to take a look at. And as that chart goes up, this is a point and figure chart. Many clients and folks on here know that I like to use point and figure charts because it gives you a crystal clear image of supply and demand. No 50-day moving averages, no 200-day moving averages, just supply and demand in an index or security. When I look at this chart, this is the type of chart I'm interested in buying. You see a very strong breakout out of a base and now a pullback. If I can put my ideal type of buys together for new capital, it's strong trends, strong relative strength on some weakness. And that's what this chart is showing me. Now I'm going to pop up. Keep in mind, I didn't say what this chart was, because I like to look at charts occasionally with a clear mind, not with a preconceived notion of what I should be seeing. So when I pop up what this chart is, you'll notice it's QQQ, the NASDAQ 100. As many of you know, in our tactical trend, that's our largest position. Has had a wonderful move. We've owned it for years. It's compounded performance-wise nicely. Now it's pulled back, but it's pulled back after a very, very nice breakout. This is the type of security, even in this headline-driven newsreel and market reel, that I want to be allocating capital to, not selling. Allocating capital to. I like to do this in all asset classes, equities, fixed income. Try to look at supply and demand in a security, in an index, in a commodity, without the header on that particular commodity. It lets you look at things clearly without preconceived notions. Try it sometimes with whatever chart you like to look at. It doesn't have to be a point and figure chart. Okay, I want to give you some other information. We had some extremes. As many of you have met Leo Chen, Dr. Chen is our quant analyst here. He had multiple buy signals in our quant strategy. Keep in mind, we've had previous signals. So these are add-on signals. What we have found in the past is clustered signals tend to give us a solid long-term performance out of that signal. One signal by itself, sometimes not quite as strong. These clustered signals, 4 out of 5 days this week, make us think that some of the extreme pessimism is starting to really show up. I wanted to share with you some of the movement. Keep in mind, Wednesday of last week, the S&P hit all-time highs. So last week on the video, I said there are some things to be concerned about, even though the S&P was hitting all-time highs. And that was the advanced decline line had weakened. New highs, new lows had flipped to where we weren't seeing the same kind of power. Gold had a bid. So there were some areas, fixed income bonds were rallying. There were some areas that had us concerned, and we had raised money in our tactical portfolio to about 23-24%. What I didn't expect was the quickness, the breathtaking drop. In the past, when you're trading in a decent trend above the 200-day moving average, you have some time to react to these weakening pieces underneath the hood. I just want to share some facts that I think you might find interesting. This is through Wednesday's close, by the way. I'll calculate Thursday and Friday over the weekend. S&P 500 has pulled back almost 8% in 5 trading days. Since 1950, there have only been 54 times when the market declined that quickly. By the way, that's not the point of what I'm going to discuss here. That's nice, interesting information, but we'll get to that in a moment. There have only been 2 times in that period when we've seen such a quick drop when the market was above its 200-day moving average or in a positive long-term trend. The first was October 97. You can read that. Second was February 18. Go down to the bullet point. In both cases, the peak to trough drawdown was contained at about the 10-11% range in 97 and just over 10% in 2018. In both cases, S&P had strong rallies afterwards. Does not mean we're going to rally Monday, Tuesday, Wednesday. This is a very rare event if we've only seen it from a strong positive trend a couple of times dating back to 1950. We want to be aware that most fierce drawdowns, and this week was fierce, but I'm talking about 20, 30, 40, 45, 50% drawdowns, tend to happen from weak trends that have already started. So we want to be aware of that. We've had a strong trend, strong relative strength in U.S. equities versus other asset classes. Perhaps this was a drawdown off of this last 3 or 4 months move that needed to be consolidated. We won't know that for the next few weeks, but we are willing over the last couple of days to push some chips into the middle of the table on this pullback. We'll see how they work out next week. We'll see how they work out 2 weeks from now. So just to conclude, fascinating movement in the fixed income market. Really, the 30-year Treasury down through the S&P 500 is something I haven't seen before. It has happened briefly a couple of times over the last 50 years, 75 years. When it has happened, it was for a very brief period before rates either rose again or the market rallied enough to drop that dividend yield. So we'll see again. We don't try to predict. We try to look at data, analyze data, use our analytics to make intelligent risk-reward decisions. So let's see what happens next week. Everyone have a great weekend.